Hello and welcome back to my channel Accountancy. Here I am today with the topic of provision for depreciation account is to be maintained or not to be maintained. And second most important thing is when your depreciation rate is given without per annum. What treatment is to be done when your depreciation rate nothing is mentioned with along your rate that it is per annum. How this is to be treated, and another thing is how to prepare provision for depreciation account, and when provision for depreciation account is not maintained, how we prepare the machinery account. So let's start, guys. First of all, I am having here a statement that in which it is given that on 1st of January 2022, we can limited purchase the machinery for rupees 8 lakh. Depreciation rate is 10% method given as straight line method or fixed installment method in which depreciation per annum remains constant, right? So when I am considering this 10% rate on rupees 8 lakh, I have to charge 10% depreciation on rupees 8 lakh, then it would be 8 lakh multiplied by 10% rupees 80,000. This is annual depreciation, per annum depreciation, which would remain fixed under the straight line or fixed installment method. The point here is that in this question I am not given here per annum. So in this case, whether the machinery is purchased on 1st of January or the last of January or the last date of the depreciation of the for the given year, we will not consider the days or months, rather we will take the full depreciation, that is rupees 80,000 here. Right, earlier in the previous sections we have done that depreciation for the year depends upon the usage of the asset, but what I am saying over here, we will not see the usage of the asset, rather we will charge the depreciation 80,000 per annum every time in this particular question, right? So first of all, our decided case is that depreciation would be taken rupees 80,000 in this particular case because method used is fixed installment or straight line, right? The second thing is when he is asking me to prepare, not to prepare the provision for depreciation account or to prepare the provision for depreciation account. So today, first of all, we are doing A part when provision for depreciation account is not to be maintained. In that very case, how the machinery account is prepared. It is the similar that we used to do earlier. Date, particulars, amount column on the debit side also or on the credit side also. Now we are having 1st January 2022 to bank account we purchased a machinery worth rupees 8 lakh. This is to be reduced as by 31st March 2022. So here I said depreciation would amount rupees 80,000. We will not reduce it for the usage months. So we took the depreciation 80,000. Now 8 lakh minus 80,000. How much is the balance carried down? Balance carried down, that is 7,20,000, which is the balancing figure from here. On the debit side we have 8 lakh total, 8 lakh minus 80, 7,20,000, again total is 8 lakh. Now what you have to brought down is two balance brought down. What was carried down? Same here, 7,20,000. It was brought down on 1st of April 2022 because year ended on 31st March 2022, so next year would start on 1st of April 2022. So we got the balance 7,20,000 here. Now on this again depreciation would remain fixed, that is rupees 80,000. So we calculated the balance of the asset 7,20,000 minus 80,000, 6,40,000. That is my balancing figure here. 7,20,000 minus 80, 6,40,000. That is brought down to the next very year, 6,40,000. Again depreciation 80,000 for the full year, and balance carried down as on 31st March 2024 is 5,60,000, which is brought down on the another year, that is 1st April 2024. This is the similar case that we used to do that I have discussed in the last videos also, where no provision for depreciation account is maintained, means simple machinery account as we used to prepare. Now we are with the B part where he is asking me to prepare prepare the provision for depreciation account along with your machinery account. So in this case, how we have to do? First of all, you have to consider that machinery account would be simple machinery account. Means what? That if I have to prepare the machinery account till 31st March 2024, in that very case, the year brought down on which we purchased the asset was 1st of January 2022. To bank account, we purchased the machinery for rupees 8 lakh here, right? Now, in this very case, when 31st March 2022 would be there, the balance carried down for the machinery would be taken with rupees 8 lakh. But where did the depreciation go? For depreciation particularly, we are preparing a second account which is known as the provision for depreciation account. How it is prepared? Let's see. I'll let you know the journal also, but let's focus on the account. From account, it would be easy for you to prepare the journal. First transaction we did machinery to bank account, right? In the normal question, we were taking depreciation here as on 31st March 2022. Now, depreciation will not be taken here. Rather, that depreciation would be taken to which account? That is provision for depreciation account. So here we will write by depreciation account rupees 80,000, right? So here we have took the amount rupees 80,000 for the depreciation charge of the year. Now that means there is no depreciation here, so this account is closed with 8 lakh rupees. No reduction in the balance is shown here, right? But we took the depreciation here with rupees 80,000. So what is the provision for depreciation account balance? As on 31st March 2022, you know we have to close the account, whatever account we have opened. We opened the account provision for depreciation, we took depreciation 80,000. Now, what is the balance of the account? That is 80,000. Debit and credit is to be meant for the same total. So, what is the balance carried down here? That is 80,000, 80,000. Now see, you will say that this means depreciation is not charged on the asset. No, it is not like there. In this particular case, actually what has happened? See, here the balance of the machinery was on the first year. Okay? We are taking it for the first year. What is the balance carried down or brought down of the machinery in the first year is 7,20,000. Now see what we have done here. We have done here two balance brought down for the machinery is 8 lakh as on 1st of April 2022. But as on 1st of April 2022, what is the balance brought down for your provision for depreciation account? That is 80,000. So see what we have done, actually we showed machinery with a debit balance of rupees 8 lakh and credit of provision for depreciation account with rupees 80,000. So what is the balance of the machinery here? The balance of the machinery here is rupees, that is 7,20,000. Right? So this balance is telling with this balance. There is no difference. Just we opened a simple another account which is named as provision for depreciation, where we are taking all the depreciation of the asset. It means that machinery account never be shown with a reduced value here. So on 31st March 2023, when we charge depreciation here, we will not take depreciation here. Depreciation will be taken to another account 31st March 2023 by a depreciation account. Here also I fixed the depreciation with rupees 80,000. Already calculated, it was rupees 80,000. That means the balance brought down of the machinery was same for the balance carried down of the machinery with rupees 8 lakh, because we have not reduced its value in the machinery account. So what would be the machinery balance brought down as on 2023? To balance brought down of the machinery would be 8 lakh again. So now let's check what is the provision for depreciation balance. Here depreciation is totaling with rupees 1,60,000. So this would be carried here to balance carried down is with rupees 1,60,000 as on 31st March 2023. Just you have to remember the date for the same case year, as you mentioned here, same year. So 1,60,000 remains the total of the account. Now the next year brought down balance would be 1st April 2023. To balance brought down of the account would be 1,60,000. Now let's check what is the value of the machinery as on this particular date. That is, as on 1st of April 2023, machinery showed a balance of rupees 8 lakh and provision. That was the debit balance. Now provision for depreciation is the credit balance 1,60,000. What should be the balance of machinery? 6,40,000. See in your normal account, is it 6,40,000? So let's see over here. That is on 1st of April 2023. It is 6,40,000. So there is not difference in the balance. The balance would remain the same. But the point here is that we are preparing a separate account for depreciation. Now again, that we have to charge the depreciation on 31st March 2024. By depreciation we should have written over here. We will not write there. Copy the same date into the another account of provision for depreciation. Write your depreciation here by depreciation account, that is with rupees value of 80,000. So what is the depreciation total here? 2,40,000. Make a balance of your account to balance carried down, because we have a total of 240. So what is the balance left in provision for depreciation as on 31st March 2024 is how much is the total depreciation? 2,40,000. Now we are bringing it forward 1st of April 2025. What is the balance of your this provision for depreciation account? That is 2,40,000. So machinery balance would be carried down with the same, no change would be done here. It would remain same 8 lakh rupees. Closing the account with the double lines, and then again to balance brought down, that is in the next financial year, 1st of April 2024, that is 8 lakh rupees. Now let's check again. As on 1st of April 2025, it is 24. So what is the balance here? That is 8 lakh is the balance of the machinery, and what is the provision for depreciation? 240. So what should be the balance of the account? That is 5,60,000 rupees. See in your account, machinery account, normal account, this is 5,60,000 rupees. So just your machinery account is divided into the two parts. In the first part, we are keeping the balance same, no change in the balance. Rather, whatever depreciation we were taking here, 80, 80 and 80, for that we opened which account? This is provision for depreciation account. By depreciation, first year took the balance carried down, second year added with the new depreciation, took the balance carried down, third year added with the third year depreciation, took the balance carried down, and then brought it down. So now understand the journal entry. In this case, we were making the journal machinery account debit to bank 8 lakh, and then depreciation account debit to machinery account. But what particular journal is made over here? First year machinery to bank. But for charging the depreciation, we were taking depreciation account debit to provision for depreciation account. Depreciation is charged to which account? That is provision for depreciation account. Is it clear to everyone? I suppose it should be clear. One thing highlighting over here is I had not taken per annum point. That's why the depreciation is fixed every year with disregarding the months or the given days for the usage. So this is for the day. I'll be coming with the part continued for your sale or purchase in this method. Thanks for the day. Like, share and subscribe. Accountative. Keep scoring.